I do think that markets took from this a certainty that this tapering will happen. As you say, we're making progress. We're going to get there. These are words of sort of, let's say, a sequence or transition to that ultimate goal. Obviously, they're debating it. They're debating about how fast to do it, debating, of course, when, and they're also debating a bit about, the impact that it could have, particularly on the economy. As you say, the Delta variant is here. It's going to impact the economy if it isn't already. And so to time that is not an easy thing. I think what markets really then took from this is like, we don't really have to deal with too much Fed policy uncertainty at this point. And I think this is why in the session what you saw yesterday was a bit of a revival of the markets. In addition, that yields stayed relatively stable, with the only thing that real yields are declining, which is just still a reflection of high inflation, but a strong economy. So markets, I think, are pretty comfortable at this moment with where the Fed is taking this.
So comfort is a word that I've heard a lot from traders and investors over the course of the past few weeks here with regard to the current levels that we're at. It's not so much this idea that the Delta variant, is going to take the economy or markets down, but there's no real catalyst to get things moving to the upside for sure right now. We thought earnings season was going to be that catalyst. What exactly is the path of least resistance for the markets right now? Is it still to the upside?
I think it's still to the upside, Dom, because think about it. We're in an economy that's still growing close to about 8% real GDP. We're going to get the GDP data out later today. And if you're in that kind of economy, you cannot have really a deceleration of earnings so fast that would then take down the stock market. So we're sitting here at the upside. It feels like record highs, but the projection on a lot of the earnings going forward remains strong based on that GDP number in itself. Then I think we're in an environment where, we have a bit of a rotation going on between small and large cap. That's probably the somewhat defensive posture. But we also still have the reopening that's not really being disrupted. We could have some slowdown around it because of the variant, but we are very accustomed now to it. As Chair Powell said yesterday, the impact of the next wave will be incrementally less than the previous wave. So I think the market sits pretty here, probably has more upside from here.
From a strategic standpoint, one of the biggest concerns over the last several months now has been this notion that inflation could be the real thing that takes down this market. Interest rates would have to climb to kind of clamp things down a little bit. Is it fair to say right now that given commodity price movements over the past few weeks, that this inflation narrative has really become somewhat transitory, as the Fed has been advocating for quite some time now?
I think the market is on that same notion that we deal with transitory inflation because if you do reopen, you have shift in prices, as Powell said himself, but you don't have this acceleration, month after month after month so much that then you do deal with inflation that's going to show up in expectations, and those expectations become too elevated, and then the Fed has to react to it. So we're not there at all. We're actually more about we reopened the economy. We're going to have to let it settle out. So the market, I think, very much understands that this is just a phase of the economy where you deal with suddenly somewhat high inflation. So all along, the inflation-linked bond market has already said, like, you're going to go decelerate over the course of the next year in inflation. I think that's what the stock market believes.
Shepard Smith here. Thanks for watching CNBC on YouTube.